Some of you watching this should not buy a house this year. And yes, I'm a real estate agent. I know. That's not what you expect me to say, I'm sure, at all. But at 7% mortgage rates, buying is no longer automatically the right answer. Sometimes renting is stronger. Sometimes waiting is stronger. Sometimes liquidity is stronger. And if that sentence makes you uncomfortable, good. Because that means we're about to have a real conversation. For decades, we've heard renting is throwing money away. The argument was easy at 3%. It's lazy at 7%. Today we're not debating pride. We're not debating what your parents did. We're running numbers. And by the end of this video, you will know whether buying or renting strengthens your position in 2026. If you appreciate housing conversations that don't default to hype or fear, subscribe. We model structure here, not emotion. So, let's start with the math. Let's model a mid-tier national example. $650,000 purchase, 20% down. That's about $130,000 in cash. Loan amount, $520,000. At 7%, principal and interest is roughly $3,450 per month. Most people stop there. That's the mistake. Because principal and interest is not the housing cost. Now, layer in property taxes. In many areas, that's $600 to $800 per month. Let's use $700. Insurance. Stable states, $300 to $400. Volatile regions, $500, $600 more. Let's conservatively say $400. Maintenance, reserve. 1% of property value annually is common. $1,650, that's about $6,500 per year, roughly $540 per year. Now add it. $3,450 plus $700, $400, $540. That's approximately $5,090 per month. Not $3,400 a month. $5,000. And that's before an HOA. Now, let's compare that to rent. Comparable rent. About $3,200 per month. Difference? Roughly $1,800 monthly. Over $21,000 per year. Because this is where people's emotionally short circuit, usually. That $21,000 is not wasted. It's liquidity. And liquidity has value. Most certainly. But we're not done, because now we have to talk about opportunity cost. Excuse me. You put down $130,000, let's say. That money is no longer liquid. It's converted into equity. And equity can grow. But equity is not cash. If that $130,000 stayed liquid at 5% in a high yield account, about $6,500 per year at 7% invested conservatively, over $9,000 per year. Now combine that with the $21,000 payment gap. You're approaching $30,000 annually in capital flexibility. $30,000 every year. Now ask the real questions. How much appreciation would the house need to generate to offset that? At 3% appreciation on $650,000, that's about $19,500-ish a year, which doesn't fully offset the payment, plus opportunity differential. Now, appreciation may exceed that, or it may not, but liquidity is certain. This is why 7% changes the equation. Not because buying is bad, because capital has a cost, again. But the real variable, time. 2-year hold. You pay purchase closing costs. You likely pay around 6% when you sell. $1,650,000. That's $39,000 in selling costs, roughly. Add purchase friction. You're easily $50,000 deep. Short holds at 7% are risky. 5-year hold, better. But only if you don't overpay. Only if you're stable. 7+ year hold. Historically, buying begins to dominate renting in stable markets because appreciation compounds. Transaction, it costs dilute. 10+ years, buying almost always wins, historically. But only if you stay. Mobility changes everything. If there's even moderate uncertainty about staying, renting often wins mathematically. Most people overestimate how long they'll stay. Life has other plans a lot of times, right? So. Let's get clear. Renting is strategic F. You have less than 6 months. Reserves. Your housing payment exceeds 30% of your gross income. Your job may change within 3 years. You're unsure of a 5-year plus horizon. You're entering a high insurance volatility, those regions like Florida. You're stretching just to get in. That is not weakness. That is structural sensitivity. And at 7%, sensitivity matters. Renting buys flexibility, liquidity, optionality. In leverage cycles, optionality has value. But now here's the part people don't expect. There are absolutely people who should buy at 7%. Buy makes sense if you have 12 months of reserves. You're confident in 7+ year hold. You negotiated below the peak comps. You verified insurance costs before your contract. Your payment sits comfortably below that 30% of your income. You're not relying on appreciation to make the math work. Buying is not automatic, but it can still be powerful because buying provides control. Renting provides flexibility. The question is, which do you need more right now? But region does change everything, most certainly. Yeah. National commentary usually misses this. Insurance volatility, HOA reserves, special assessments, property tax resets. In South Florida, for example, A $25,000 special assessment equals roughly $1,000 per month for 2 years. That flips buy versus rent math very quickly for a lot of people. In lower volatility Midwest markets, insurance is pretty stable usually. HOA exposure is lower. Buying math strengthens. The answer is not national, it's regional. So blanket advice that you hear usually fails. Model your actual geography. Now let's go ahead and simplify. If 3 or more of these apply, renting is likely stronger. Less than 6 months of reserves, uncertain job horizon, payment over 30% of your income, high insurance exposure, short hold timeline, stretching to go qualify. So if 3 or more of these apply, buying is likely stronger. 12 plus months of reserves, 7 plus years of hold, negotiated entry price, stable income, comfortable payment ratio, insurance was verified. Now if you're in between, you need a little more modeling. Not pressure. Excuse me. If rates drop to 5.5, refinancing approves, buying math. Demand increases, negotiation windows compress. If rates remain elevated, liquidity continues to matter. Patience continues to win. Either way, prediction is weaker than preparation. Renting is not failure. Buying is not automatic success either. Positioning wins. If this helped you think clearly about your own situation, subscribe. We build these frameworks layer by layer. Comment your city and whether you're leaning rent or buy at 7%. I read those. Thank you.